Hey Bowtie Nation, Joseph Hogue here with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. The market is reaching new all-time highs, and I found 10 stocks the market loves. In fact, 9 out of 10 analysts are recommending these 10. I'll reveal those stocks to watch, along with the 10 that everyone hates right now, along with important news on shares of Alibaba, Supermicro Computers, and Sofi Technologies. But first, I want to highlight one of my favorite cash flow investments right now through the Arrived Homes platform. The platform packages rental real estate as LLCs, so you get a direct investment for less than $100 and without the massive down payment or management headaches you get from rentals. You earn dividends on that rental income, and Arrived has recently transitioned to a monthly dividend payments, so you're earning from 3 to 8% annualized and getting that cash flow every single month, along with the price appreciation when the property is sold. This is one of my favorite investments right now, but I know you've got a lot of questions. I know I did before I started investing, so I'm going to link in the description below to the platform. One thing though, the homes available for investment sell out fast, so make sure you click through and get on the notification list. Back to our main topic, and FactSet Research is out with its survey of analysts' buy and sell recommendations, with 10 stocks with almost unanimous consensus from analysts. In fact, at least 9 in 10 Wall Street analysts are recommending you buy these stocks. On the list is also 10 stocks with fewer than 2 in 10 analysts recommending them, and some without a single cheerleader on Wall Street. Now, nation, you know I'm not one to bow down to the altar of Wall Street. Hell, during my time as an analyst, some of the guys I knew couldn't forecast the weather if they were outside. Good guys, they just couldn't tell cash flow from a kabuki show. But what you can do is take these analyst recommendations, especially the stocks with nearly unanimous buy or sell recommendations, and use that to start your research. I'm going to show you both lists, digging into the sector trends and valuations to create your own list of stocks to buy and ones you need to avoid. I'll also reveal a big red flashing warning sign on the market right now and why you need to have a strategy to invest over the next few months. Here, that top 10 list includes 3 of the magnificent 7 stocks, Amazon, Microsoft, and Nvidia, but is surprisingly light on tech stocks. This will make more sense in valuation data I show you later, but I still expected to see more tech recommended. Energy stocks don't make the list much either, except for Schlumberger, despite the fact that overall, analysts see the top sector returns in energy over the next year. We see that looking at the big picture analysis, the difference between the price targets for all the stocks in each sector versus the current prices in those stocks. Analysts expect an upside of almost 17% to price targets over the next year in energy stocks and over 15% in tech stocks. So it seems Wall Street is saying there are fewer screaming buys in tech and energy, though the overall sectors are attractively valued. That could set up for good investments in the sector ETFs like the XLK for the tech sector or the XLE for the energy, both of which invest broadly across those stocks in the sector within the S&P 500 index. Rounding out that top 10 recommended stocks, we also see healthcare represented here with UnitedHealth and 2 airlines with United Airlines and Delta. Now, I'm skeptical there's much left in the airlines though, as the shares have a great run this year. The airlines benefited from record high travel this summer, but still disappointed on operational performance. Here, I thought it was surprising that Wall Street thinks the run is over for real estate stocks, with forecasts for just 3.2% upside to those sector price targets. Financials is also expected to return just 4.6% to those price targets over the next year. Now, both of these sectors underperformed as those interest rates soared over the last few years, could have the best surprise outperformance as rates come down over the next year. And again, if you don't want to pick stocks in these sectors, the spider ETFs like the XLRE for real estate and the XLF for financials provide broad exposure to those groups. Another point where I disagree with the consensus here. I think the good news can continue for those stocks in the utilities as well as healthcare and financial sectors. Looking at the biggest surprises in last quarter's earnings, we see all 3 groups easily beating analyst estimates. Stocks in utilities and healthcare beat expectations by 8.6% on average, the 2 biggest surprises for the market, while stocks in financials beat by 7.5% for the quarter. And I'll show you those 10 stocks analysts are saying to avoid like the plague, but it might pay to be more cautious than usual over the next few months. First, investor sentiment is weakening, with the market taking any excuse to sell out of a stock. If we look into stock performances for the second quarter earnings reports, stocks that were able to beat their expectations were rewarded by just a 0.9% upside. That's slightly under the average 1% bump stocks usually get when they beat those estimates. Any stock disappointing the market, though, got crushed, falling by an average 4.3% around its earnings. It's nearly twice as bad as the long-term drop of 2.3% on a missed earnings call. That means you need to be especially mindful of valuations, as those stocks with stretched valuations are going to be the ones that sell off harder on any disappointment. Here, sector valuations are a good place to start, with the overall S&P 500 priced at 21.4 times those expected earnings over the next year. That is a 19% premium, 19% more expensive than the 10-year average PE ratio. Looking at these individual sectors, and I've marked how much above their average PE ratio they are in red. Stocks in 5 of the 11 sectors are trading at 20% or more of their long-term valuations, including financials, healthcare, materials, industrials, and technology. On the other side of this, 3 sectors are trading at relatively attractive valuations overall. Consumer discretionary stocks sold off last year on fears of consumer slowdown and are just 8% more expensive than their long-term average. Despite a strong 27% run in the sector this year, stocks in the utilities sector are just 3% more expensive than that average, and energy stocks are actually trading at a discount, still 19% cheaper than that average 10-year PE ratio over the 10 years. More broadly, while the market isn't as expensive as it was during the pandemic when the S&P 500 traded at over 30 times on that trailing PE basis, it is still undeniably expensive, and that's contributing to this skittish investor sentiment. Stocks in the S&P 500 are trading at a price of over 26 times the earnings reported, well over that 10-year average of 22 times PE. So here, while I am still buying stocks on those selective opportunities like CrowdStrike and SMCI, I'm also keeping 10 to 15% of my money in cash and money market accounts for that ready source to buy on the dip. That's quite a bit more than I usually keep in cash. In fact, this market reminds me of the 2017-2018 period where stocks did really well after the tax cuts, but by late 2018 were well ahead of themselves on that valuation. A mild breather started in October, accelerating into December with a 17% sell-off, but set us up for a strong rebound in the next year. Looking now at the 10 most hated stocks by Wall Street analysts, there's very little rhyme in terms of sector here. Financials are represented by both Franklin Resources and T. Rowe Price, though both of these companies have been going through some operational problems that aren't really indicative of the broader sector. Consolidated Edison has been swept up in the rise in utility stocks this year, enjoying a 23% run, but here, investors need to remember that not all utility stocks are going to benefit from that AI data center demand. Those regulated utilities selling to residential markets like Con Ed typically have less excess capacity that they can sell and are limited on the upside on their rates. Contrast that with the independent power providers that may have more capacity and can make deals on those higher rates like Vistra, NRG Energy, and Talon Energy. Looking now at the stocks I'm watching this week, Alibaba Holdings, ticker BABA, is the perfect example of why you need to have the conviction and the patience in your stocks to see them through. I've been screaming Baba was in deep value territory since late 2022, buying more each time it dipped. Now, I'll admit, much of the last year was rough, but I built up a position of 1,200 shares along with 85 call contracts for another 8,500 shares based on the company's e-commerce leadership, its progress on its AI model, and just ridiculously low valuation. On the recent run, I'm now up about $267,000 in the shares and options. Not a bad upside for a year of waiting. Shares could make it back to last year's high around $120 each on this momentum, but it's no longer in that deep value it has been. On 10% revenue growth, the shares aren't expensive here at 2 times on a price-to-revenue basis, but I'm not convinced China has fixed its economic problems with the latest round of stimulus. I'm not adding to my position here. I think you still can for that long-term holding, but would consider selling call options against it at a $130 strike price, so offsetting that price by almost $12 and still having that upside to $130 over the next year. Super Microcomputer, ticker SMCI, was the big news last week, crashing 12% Thursday when it was reported that the Department of Justice was asking questions around the accounting practices. The DOJ is following up on that short seller report published by Hindenburg Research that highlighted a whistleblower complaint about the company's accounting practices that could be used to inflate revenue. I actually used the sell-off as an opportunity to buy another 100 shares, now a position of $125,000 at about a $434 cost basis, so down just 4% so far. The company still hasn't filed its annual 10K report, likely delayed as it figures out what it needs to restate, and will probably have to restate some of those past financials, but as I've said lately, none of this is a big threat or existential threat to the company or stops it in that leadership of the biggest growth theme right now, that data center build-out. SMCI builds data center hardware like no other company is and is expected upwards of 87% growth this year. As that data center infrastructure tries to keep up with a growing AI demand over the next several years, we're going to see revenue continue to grow at those strong double digits. Now, against this, the investigation and potential charges of the company are likely to be kind of insignificant. For example, in a previous case, the company was fined just $17 million, and CEO Liang was forced to return $2.1 million in stock profits back to the company. Hardly something that should have cut $45 billion from the company's market cap since March. Of course, there could be more that we're not seeing just yet, but none of this strikes me as an existential risk to the company, even though the market is treating it as such. Sofi Technologies, ticker SOFI, has also been on a strong run lately, back up to $8 a share, taking my position up to $50,000 in unrealized gains. And I'll continue to hold on to this as a long-term investment. Management is forecasting up to $1 billion in added book value this year, taking the book value per share to around $6.50, which even at an $8 a share would mean a price to book still just of 1.2 times, which is super cheap for a bank stock with this kind of growth. Now, most of SoFi's funding is through deposits, which are going to get cheaper as interest rates fall, and we should see profitability rise over the next year. If the shares do approach maybe $10 again over the next year, I might consider covering some of my position with those short-term call options at maybe a $12 strike price, but again, we're looking to hold on to this one long-term. Showing you that bigger picture here with the Sector Spiders sector tracker. 6 of the 11 stock sectors did close higher last week, with stocks in materials and industrials boosted on that stimulus in China and hopes for a cyclical demand in the global economy. Previous efforts at reviving that economy in China have disappointed, so I'm still hesitant to call the all clear on materials. Stocks in energy and financials gave back some of the previous week's rally, but should continue to do well on those industry fundamentals and lower interest rates over the next few months. Looking out longer term here, stocks in the real estate sector are now up more than 16% in the last 3 months, nearly 3 times the return on the overall market. With a 5-year return still just of 12% on the massive hit the sector took over the last 2 years on those rising rates, there is still a lot of value opportunity in the REITs. Get dividend income on rental real estate through the Arrived Homes platform and get on the notification list with the link in the description below. Or click on the video to the right for the stocks I'm buying before they become the next trillion-dollar stocks, the next Magnificent 7. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.